So Trump just said he wants to cancel the income tax entirely, and I want to walk you through exactly what that means, why money's quietly rotating in the dollar right now, and why there's a company that may be sitting in the middle of it. Now, before I dive in, one thing I ask in return for all the work that's going on in a video like this is that you hit that button, like button. Don't forget to subscribe. And if you do that, YouTube helps push this video out to more people, which helps prepare for more people for what's happening. The US is carrying more than $38 trillion in debt, and the truth is, by every historical precedent, the current system should already be under extreme stress and really collapsing at this point. Yet the USA continues operating as if nothing's wrong, and financial markets just keep hitting all-time highs while the real economy is deteriorating. In times like these, the best way to secure your retirement is to maintain a balanced portfolio that can ride through this economic chaos. And with that in mind, I developed a list of the best 6 stocks to own in 2026. You can download for free at free.stockscommunity.com. If you're actively managing your portfolio, head over to stockscommunity.com/freedom to book your free 15-minute strategy call and chat about your stock portfolio and your goals. I'm currently offering a completely free 15-minute call on how I spot stocks before they go up. I will make you an offer at the end of the call to join our community if I think we're a good fit. And as always, this video is not financial advice. Trump just confirmed he wants to get rid of your income tax. He said it plainly out loud on camera. He believes the tariffs paid by foreign countries will, like in the past, substantially replace the modern day system of income tax, taking a great financial burden off the people that he loves. Now, whether you think that's genius or whether you think the math simply does not work, the statement alone is one of the most consequential economic ideas floated by any sitting president in modern memory, and it deserves a serious, thorough breakdown because it is going to affect your taxes, it's going to affect the economy, and it's going to affect where smart money moves in 2026. But here's the thing. The real story is not just about income taxes. The real story is about what's happening simultaneously in the Middle East, what's happening to the price of oil, what's happening to gold and silver, and what's happening to the dollar, because all those things are connected. And when you pull that thread all the way to the end, you find yourself looking at a very specific kind of company. A company with a clean balance sheet, a domestic supply story, a booming customer base, and a stock that just did something most analysts didn't see coming. We're going to get there, but first we need to lay the foundation. So let's start at the beginning. Back in the early 1900s, the number one driver of revenue for the US government was tariffs, not income taxes, tariffs. That's why income taxes were so low when they were first introduced. When the income tax was first passed in 1913, it looked laughably modest compared to what we pay today. You paid zero income tax on everything you earned under $3,000. You paid 1% on income above $3,000, and the top rate was 7%, which only kicked in if you earned above $500,000. Now remember, this is 1913, so if you adjust for inflation, that translates to paying zero taxes on everything you earn under roughly $100,000 today. 1% on income above that and a top rate of 7% only if you're earning above $16 million a year. The government could afford to keep income taxes that low because tariff revenue was carrying the weight. But over the following century, the government slowly shifted away from tariff revenue and became almost entirely dependent on income taxes instead. By 2025, the US was collecting about $2.65 trillion in income taxes, making it the single largest source of federal revenue. Tariff taxes in that same year generated around $200 billion, so the tariff tax was off by a factor of roughly 10 when it came to replacing the income tax. To actually swap out income taxes for tariff revenue, you'd need to raise tariff rates from 15% to something closer to 150%. And that's not what's on the table right now. So when President Trump says he wants to use tariffs to replace the income tax, the honest answer is that the math fully does not work, at least not yet, and not with the current tariff structure. But here's the critical point that most people are missing. It doesn't matter whether the math works perfectly right now. What matters is that Trump's already making real tangible tax changes through what he signed in the One Big Beautiful Bill Act. In 2026 is the first full year this legislation is in effect. So the changes are real. They're already in your pocket or already costing you. And understanding them is the first step to understanding where money is going to move this year. So let's walk through what actually changed. In 2025, the lower tax rates that Trump first introduced back in 2017 were scheduled to expire on December 31st. If they'd expired without being extended, taxes would have gone up for virtually every American taxpayer in 2026. One Big Beautiful Bill extended those cuts, which means taxes actually fell in 26 rather than rising, and the bracket shifted slightly. so you can now earn a little more money before crossing into the next tax tier. The standard deduction expanded from $14,600 to $15,750 for a single filer. You no longer pay taxes on tip income up to $25,000 if you earn under $150,000 a year, though this provision only runs through 2028. You no longer pay taxes on overtime income up to $12,500 a year as a single filer. You can now deduct up to $10,000 a year in car loan interest if the car was assembled in the US, and you make under $100,000 a year. Seniors over 65 making under $75,000 a year get an additional $6,000 bonus deduction. And on the investment side, the capital gains tax threshold nudged upward as well. You now pay 0 on capital gains up to $49,450, 15% up to $545,000, and a top rate of 20% above that. So the system is designed, whether you agree with it politically or not, to reward people who are investing over people who are simply working for wages. The investor pays lower rates, the investor has more tax shelter options, and the investor has more capacity to compound wealth over time. That's the structure of the system we're operating inside in 2026. Now, on the corporate side, the One Big Beautiful Bill Act kept the corporate tax rate at 21%. Without it, that rate was scheduled to jump back up to 35%. That's a massive difference for corporate balance sheets. When a corporation makes $100,000 of profit and pays 21% instead of 35%, it retains $14,000 more dollars to deploy into hiring, research, expansion, or stock buybacks. Not every corporation uses that money to create jobs. Some just return it to shareholders, but what it does unambiguously do is improve margins, improve earnings per share, and improve the fundamental valuation case for owning equities. And here's the historical context that matters. Over the last 50 years, there have been 10 major tax changes, 6 major cuts, and 4 major hikes. During those 6 major tax cuts, 5 of the 6 saw the stock market move higher over the following 12 to 24 months. The only exception was 2018, and even then the complication was not the tax cut itself, but the simultaneous tariff and trade war disruptions running parallel to it. During all 4 of the major tax hikes, the stock market also went up. The conclusion's uncomfortable for anyone who wants to time the market around tax policy. But the market generally goes up under Republicans. It generally goes up under Democrats. It generally goes up when taxes are cut. It generally goes up when taxes are raised, which means the most reliable thing you can do, regardless of what Washington is doing, is remain invested in quality companies. But that doesn't mean all stocks are equal, and it does not mean the macro environment does not matter. Because right now, the macro environment is doing something very specific and very directional that creates real asymmetry between different kinds of investments. Let me explain what that is. At the exact same moment that Trump's reshaping the tax code, something dramatic is unfolding in the Middle East. Over the past several days, the US and its partners have launched what's been called Operation Epic Fury, described as one of the largest, most complex military offensives in modern history. Hundreds of targets inside Iran were struck. Iranian air defense systems, Revolutionary Guard facilities, naval infrastructure, all hit in a matter of hours. The Iranian supreme leader was killed in an early strike, along with dozens of senior officials and military commanders. Now, let's be very clear about what the market impact of this is, because the first instinct of many retail investors was to think war means chaos, sell everything. But the picture is more nuanced and more important than that. The first thing Iran did after the strikes was to begin sending missiles across the Middle East toward US military bases in multiple countries. Most were intercepted, but then Iran made its most economically significant move. Iran moved to block the Strait of Hormuz. They began firing at container ships passing through to make clear they were serious. And this is where the geopolitics meets your portfolio in a direct and unequivocal way. So the Strait of Hormuz is not just a body of water. It's the single most important choke point in global energy markets. Roughly 20 to 30% of the world's seaborne oil trade passes through that strait. Alongside oil, significant volumes of liquefied natural gas flow through there as well, mostly headed to Asia. When you block the Strait of Hormuz, or even credibly threaten to block it, you're threatening to take 20% of global oil supply off the market. You're threatening to spike the price of crude oil from roughly $60 range, where it was trading before all this began, towards $100 a barrel and potentially beyond. And Iran knows that's their most powerful non-nuclear weapon. It's literally referred to by analysts as a weapon of mass economic destruction. And they're already deploying it. Now, here's where it gets strategically interesting, because the US may have anticipated this. Earlier this year, before any of this escalated, the US moved to gain control over Venezuelan oil assets, the largest proven oil reserve in the world, At the time, this was framed publicly as being about drug trafficking and regime issues, but think about the timing. If you're planning a military operation against Iran and you know Iran's most powerful response is to choke global oil supply, you would want a cushion. You would want your own oil supply chain that does not depend on the Strait of Hormuz. Venezuela gives you that. So while the rest of the world, particularly China, which imports roughly 45 to 50% of its oil from the Middle East, is exposed to a Strait of Hormuz disruption, the United States has at least a partial hedge. China consumes roughly 20% of its total primary energy in the form of petroleum products, and over 70% of that's imported. So a serious Strait of Hormuz closure does not hurt the US and China equally. It hurts China far more. And this is likely not a coincidence. So the sequence of Venezuela, then Iran, then the Strait, that threat's not random. It looks more like a deliberate chain of moves in a larger geopolitical chess match. And for investors, what does higher oil mean? It means energy stocks, particularly companies in extraction, transportation, and insurance. They begin to look interesting. The XLE Energy ETF was already on a significant run in the months leading up to this escalation, possibly signaling that institutional money saw this was coming. Oil tanker insurance stocks like Chubb and W.R. Berkley were notably strong as insurance rates began to climb with every tanker that gets threatened or attacked in that strait. Gold surged as geopolitically the uncertainty climbed. Silver attempted to confirm a technical breakout above that 91 and 93 key dollar resistance level, but technicians said that silver's bigger pattern still looks like a bearish consolidation. So a bear flag could resolve to the downside unless it gets back over $117 to make that pattern bullish again. Gold, meanwhile, has been fighting the $5,400 resistance level. If it can break and hold above that through all-time highs near 5,600, 700, the next technical target would be $6,000. So the geopolitical instability adds fuel to both metals, but the chart patterns still have to confirm they don't look great. So let's zoom out and connect all this back to the dollar, because here's what ties the tax story and the war story together into a single coherent macro picture. So when geopolitical risk spikes, money moves to safety. In the global financial system, safety still means the US dollar, even if the US is the country doing the destabilizing. So the paradox of the dollar as a reserve currency is that global chaos tends to make the dollar stronger, not weaker. When oil prices spike, global trade disruption increases and fear enters the market. Institutional capital, particularly from Europe, Asia, and emerging markets, rotates into dollar-denominated assets. US treasuries, US equities, and cash in dollars all become magnets for that capital. At the same time, the One Big Beautiful Bill Act is keeping corporate taxes low at 21%, making US stocks structurally more profitable than they would otherwise be. And the Fed, which pumped $90 billion into markets as recently as early February 2026 to stabilize conditions, has signaled it has no plans to stop. So you have fiscal stimulus through tax cuts running parallel to monetary stimulus through Fed intervention, and geopolitical instability driving safe haven flows into the dollar. So that's not one reason for money to rotate into dollar assets. That's three simultaneous reasons stacking on top of each other. So the question for investor is not whether to be in the market, it's to look at history. History is extremely clear that staying invested is the right long-term posture. The question is which companies are best positioned given where we're actually at right now. And this world is a terror-driven cost pressure, dollar-strong domestic brand premium, expanding middle-class healthcare spending, lower corporate taxes, margin expansion. All this together makes one company extremely interesting. It's a company people have not been paying close enough attention to, in my opinion. It's FIGS, ticker symbol FIGS. It's on the New York Stock Exchange. Before I dive into FIGS, quick side note. If you haven't seen what's inside of my six-figure strategy call in stocks community, click the link in the corner of your screen right now. It's a rare inside look at one stock. And I have daily calls like that with beginner, intermediate, advanced 6 to 7 figure investors who ask me questions specifically about stocks. It's one-on-one. If you click that link, you'll get a taste of what that experience looks like. And if you want more material like that with, charts, I have a whole library of it completely free in the videos tab. Just sort by oldest videos first on YouTube. If you want to be part of this going forward, we run these calls every single weekday. You can apply to work with me at the link below if you're ready to take your stock investing to the next level, and if you qualify for the $25 trial. So what is FIGS? Who is FIGS? If you've ever been to a hospital, a doctor's office, a dental clinic, or a surgery center in the last 5 years, you've almost certainly seen their product without knowing it. So they make premium medical apparel, scrubs, underscrubs, jackets, footwear, and accessories. Designed specifically for healthcare professionals, they're the brand that turned what used to be a purely functional uniform into a cultural identity. So healthcare workers don't just wear figs, they identify with figs. They buy them as gifts, they build their wardrobes around them. They post about them, they recommend them to every new coworker who joins their unit. There's a lot of nurses out there. And that kind of brand loyalty is extraordinarily difficult to manufacture and extraordinarily difficult to displace once it's established. So here's what the most recent earnings showed. Figs reported Q4 2025 net revenues of $201 million, just about. That's up approximately 30% year over year. Wall Street consensus had been expecting revenue around $160 million. So Figs beat that by a wide margin. The earnings per share came in at 10 cents. The consensus estimate has been 2 cents, so it's a 400% earnings surprise, not 4%, 400%. Net income jumped to $18.5 million compared to just $1.9 million in the same quarter a year ago. Profit margins expanded to roughly 9.2% from around 1.2% in the prior year. Adjusted EBITDA rose to $26.7 million with a margin over 13%. Active customers hit a record 2.9 million, so it grew about 10% year over year. Average order value increased. U.S. sales grew almost 30%. International revenues grew over 50%. The stock reacted accordingly. Shares jumped as much as 25% after the earnings release and hit new 52-week stock highs. And several analyst firms upgraded their rating to strong buy or overweight in the days after that earnings. So let's be honest about the headwinds, because nothing's worth analyzing, in a vacuum. Gross margins contracted to about 60%, down roughly 440 basis points year over year. And that compression came from a combination of higher tariff costs, a $5 million inventory write-off, and the basically lapping of prior duty drawback benefits. Management was transparent about this, incorporated tariff assumptions directly into their forward guidance. So here's where that guidance becomes interesting. Figs is forecasting 10 to 12% net revenue growth for full year 2026. They're targeting low 20% revenue growth in Q1 alone, and they expect adjusted EBITDA margins to expand to somewhere between 12 and 13% over the course of the year. So if this all sounds Greek to you, it means management's telling you, yeah, we have tariff pressure, we took an inventory charge, and despite that, we're still projecting margin expansion and double-digit growth. So why does all these numbers matter? Because, well, we just spent the last 20 minutes talking about a macro environment that punishes companies with fragile supply chains, thin margins, heavy import exposure, weak brand differentiation. Figs has healthcare professionals as its core customer. Healthcare employment is one of the most recession-resistant sectors in the whole economy. You don't cut back on nurses and surgeons when the economy slows down. You don't stop buying scrubs just because oil prices are spiking. So in fact, in a world where inflation's running higher, tariffs are compressing margins across consumer goods, and the Fed's still pumping money into the economic system, that world actually rewards companies that have pricing power, and Figs has demonstrated through its record average order value that its customers pay up. They're not buying Figs because they're the cheapest option. They're buying Figs because they've decided that Figs is the only option that reflects who they are as a professional. So that's sort of brand equity, and it's durable pricing power, and exactly the kind of moat you want to own when the macro environment is as unpredictable as it is right now. On top of that, there's the corporate tax story. So with the corporate tax rate locked in at 21% instead of jumping to 35%, companies like Figs, which are growing into profitability, not retreating from it, like you worry about some of these software stocks, they get to keep more of every dollar they earn. So in a year where Figs is going from a company with tiny margins to real margin expansion, the tax environment is providing that tailwind when it's most valuable. The international growth story at over 50% is also worth highlighting in the context of a stronger dollar environment. So when the dollar strengthens globally, US-based companies that generate international revenues in foreign currencies typically feel some headwinds on the sort of translation side, but 50% international growth is a number that suggests Figs is in the early stages of a global expansion that has a lot of runway. They're not yet dependent on international revenue, it's additive. So the currency translation headwind is manageable while the brand expansion opportunity is enormous. Now, is Figs without risk? Absolutely not. It's a tough time in the market. Anytime you see a stock jump 25% following the earnings report, you have to ask yourself whether that move's already priced in the good news. So the honest answer is some of it probably has been priced in. The gross margin compression from tariffs is not fully resolved. The inventory write-off was real. And in a market environment where geopolitical chaos can send the whole stock market lower on any given day, regardless of fundamentals, having a catalyst-rich stock with a big recent move means volatility cuts both the upside and the downside. But here's the framing that matters. We're talking about a company that beat revenue estimates by more than 20%, beat earnings per share estimates by 400%, generated record customer numbers, and gave forward guidance that management clearly believes is enough to state publicly. So in a market where most of the confusion right now is about macro, tariffs, Middle East, dollar moves, Fed policy, FIGS is a company that's operating from a position of fundamental strength. It's not trying to survive the chaos, it's growing through it. And that ultimately is what the entire discussion has been building towards here. So in an environment where money's rotating into the dollar because of geopolitical risk and fiscal stimulus, in an environment where corporate tax rates are staying low, investor tax rates are being restructured to reward ownership and not just labor, but in an environment where inflation pressures are building from oil supply disruption, the market's looking for companies that can absorb those pressures and still deliver. The names that win are the ones with real pricing power, brand loyalty, recession-resistant customer bases, and management teams that can execute. FIGS checks all those boxes. It's not a story that's fully played out yet. It's a story that's just beginning to get the attention it deserves. And that's the kind of setup I want to be looking at when the headlines are loud and obvious trades are already crowded. So what did I miss here? What would you push back on? Let me know in the comments. If you're managing your portfolio independently and want to know how I spot stocks before they go up, book a completely free call at stockscommunity.com/freedom, where I can better understand your long-term goals and your approach to the stock market. If I think we're a fit, I'll extend an invitation to my community where I teach my students how to find the best stocks, spending just 10 minutes in front of their computers a day. The link's in the description right below. And if you already have a portfolio going and you want to make sure you're in the best stocks in the market, download my best 6 stocks to own in 2026 for free at stockscommunity.com/free. Finally, if you found this information valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it, because people who prepare themselves and stay one step ahead of the everyday person will always come out ahead in the long run. So thank you for watching, and